Good evening, and thank you for joining us on You and Your Money. I'm Bryan. Our discussion this evening centers around the investment, identifying opportunities, assessing risks, and strategies for navigating today's markets. Since our last program, the news in South Africa has been very encouraging. We have been removed from the grey list recently, received an investment upgrade from the S&P, the medium-term budget was positive, and the rand has strengthened. And that was my last discussion before with David. Last week, David, I heard you being interviewed, and you mentioned that we're in a bull market. I wasn't sure whether you were referring to offshore markets, local markets, or both. But over the past few years, both international and South African markets have been driven by a small number of shares. And as you've heard, joining this evening is David Shapiro. David, lovely to have you on the show. Lots of positive news, a lot of noise. How is this going to translate into action going forward? And I've never heard you being so positive on that radio program in the week where you talked about the bull market.
I tell you what sparked that. I saw AVI's, not numbers come out, the chairman's statement at the AGM. And the chairman was a little positive about the outlook. And what happened is AVI shares went up 6 or 7%. I said, okay, if I would have read that, I said, very nice. Shares went up. I said, that's a good sign. And the next day, we had a similar story with Woolworths, where they came out with a slightly better results, slightly better than the market was expecting, with Australia turning. And the shares went up 6 or 7. I said, when markets respond to mediocre news like that, then you know you're in a bull market. And I still believe that we're in that kind of climate. There is a caveat which I'll cover as well. But I mean, overall, markets want to go better. We're not in the early stages. We're probably in the latter stages of this bull market.
Because we have been in an upside market,
yes,
even though
yes,
run, as I mentioned, few shares.
Yes, we're in a very positive market. I look at the depth of the market every day. In other words, and that's both internationally and locally. I like to look not only the top 5 or 10 stocks, I like to look across the board to see whether or not positive movements are being carried through to smaller businesses. I'm still bubble schmubble. I still think we're in very positive environment. We've had good runs up to now. You know, the S&P is up 15, 16%. I can live with that. That's why if we could go home now and I could close off till the end of the year, I'd be very happy and say to clients, phone me on the 1st of January. You know, likewise, you go away and we'll talk about it next year. And I think even for the SA market as well, it's had remarkable showing. And I think if we could close off now, I'd be thrilled.
Well, I think back to our program right at the beginning of the year, we had a great 23, a great 24. Well, let me go back. We had a terrible 22 after COVID. Yes. So I don't want people to only think markets are going up. We had a great 23, covered up, got us really back. The problem were people who made investments in 22 had to face that downturn.
That's right.
And that could be what's happening, could be happening going forward in 26. People coming in, thinking I'd like to be in the market corrects, they've now got to make back what that happened. But good 23 to good 24. We spoke about 25 being maybe consolidation, 7-8%. You're talking about double that.
No.
So, you know, so those are really things. And it's a pity that people watch their portfolios.
Yes.
You know, when you invest in property, in the balance sheet as a company, you show properties at cost. But when you look at share markets, you see what was the last price, how high was it, and the following month, how low it is. I mean, that's the difficulty for you, because the characteristic of property equities are the same. Long term, property is position, and equities is patience. But people can see these numbers, and they start to feel that much richer day in and day out because of a bull market.
You know why? Everybody carries their iPhone or phone, their smartphone around, and there are a number of applications or programs that they can use. So what happens is that they've loaded their wealth on this little phone, and they don't watch it daily, they watch it by the minute. And the problem with it, psychologically, you always look at the height at which you reached. and you say, oh, that's where we are now. So when it falls back a little, you take that as a loss. You never go back to say, well, this is where I started. And that's one of the problems we face. If we think about, and I'm going to use the American market, we're up 15%. Inflation, even sticky inflation, you can call inflation what you like, it's 3 or 4%. So you've got an 11% real return. That's not good enough for most people. So when we go into next year, Bryan, if we get 10%, I'm thrilled.
Yeah.
But you can't say to me that's the target, because people want more. And that's the challenge that we face, is continually feeding their emotions.
Dave, let's just talk about the medium-term budget. Lower inflation figures, 3% from the balance between 3 and 6.
Yes.
And interest rates are still so high. South Africans are
Yes.
struggling. If you look at the two-pot system, I'm not going to spend time on that now, I'm going to deal with that next week. But when you look at the two-pot system, the amount of money that people have taken out of the funds, and these are people who are working.
Yes.
People, because you're only a member of a pension or provident fund if you're working. And they borrowed 50, 60, 70 billion from those funds. But, they say because of this change in inflation measuring, interest rates are going to come down, but a lot more. Are we still thinking about 0.25% cuts, or are we thinking something more aggressive?
Well, the governor's mean. He doesn't like to do bigger than 0.25%. But the margin's there. If we look at the inflation numbers, 3, maybe, they've given a 1% margin for issues which can be, critical issues that can happen. The oil price can spike, or something can happen. It can be a world event. So 3% is the target. If you look at our bonds, long bond rate, that's, even though it's come down, it's 8 or 8.5. So
real rate of return,
your real rate,
even after tax.
That's right. Is even if you're paying the maximum tax, you've still got a 2 to 3% real return. So there is the margin to bring down interest rates, which I think we'll see, but it's going to be very slow. I think once America breaks away and starts to reduce rates, I think that's going to be, that will be the start of more aggressive rates. But there is a margin for rates to come down now.
Dave, were you able to have a look at the medium-term budget? Because there's a lot of positive. It's going to create growth. I can't see how medium-term budget going to create growth, because it's what we need.
Yeah, there's a wish list of investment. We need investment, and investment means fixed investment. In other words, creating the environment in which businesses can grow. That's still missing. My gauge, the gauge that I use, is I keep away from economics, because I'm an accountant, not an economist, and my training was the cash book. And I like to look at company accounts, and that's where I get hints of where this economy is. And I look at the local accounts, I look at the banks, I look at the retailers and so on. And there's a clue. I looked at Sanlam's numbers last week at something, and when you go through the numbers, they're very impressive. But when you see the growth of new business, that's slowing down, and that's a worry. And the number of new policies being sold or new business being written is kind of slowing down, reducing, not there. And you'll see that in all the major financial companies. You'll see it in Discovery, wherever you go. Forget about the bottom line and everything. That decides where growth is going to come from in the future. And that hasn't shown any signs of turning around. In other words, the consumer is still under pressure, and that's a worry. What I'm watching very closely is going to be Black Friday, November. Well, you can call it what you like. November is where all the bargains come. I want to see what the appetite to spend is there, and how this is going to reflect on the underlying economy. We should get hope from, like, the platinum miners. We haven't seen that coming through yet, but that's going to be a big boost. We've seen it in the gold miners, but they don't operate here anymore, Bryan. They're operating everywhere else but South Africa.
Well, Dave, when you think about Sandton, where this G20 conference is going to take place, I mean, I wouldn't like to be in Sandton in the next 5 or 6 days. But that does, if we're looking for investment and we're looking for foreign investment, the fact that quite a few leaders have now withdrawn from the G20, does that say anything to you? Is it serious?
Well, I interpret it saying, well, it's South Africa. We don't have to be there. And that's sad. I'm not saying it because I'm getting any joy out of saying it. I'm saying we've got to change our image. We've got to become an investment-friendly country. And we've got to be an investment-friendly, when I say country, not only economically, but politically as well. And I think it's a lot of work has to be done here. We have to change the political environment, and also from an economic point of view, we're still back in the 60s. We still got that good old 60s dogma politically. You've got to make it open for companies to come here. You don't have to set rules, and that's holding us back. And a lot of those are political rules. So the opportunities are here. We're just putting obstacles in investors' ways.
Okay, so we've got 2 minutes before the break. So this is the question. You've now got clients who've got money. So the question they're saying is, should I take money offshore? Should I bring money back and invest in South Africa? And where are you advising the smart money to go to?
Okay, I think my view is that at these levels, it's a wonderful time to take money out. But I think what I am seeing now is that if things start to improve, continue to improve, and we see it coming through in consumer confidence, then I think the banks, some of the retailers, those businesses are quite attractive here. It's a if, Brian, you know what I'm saying? I haven't got the confirmation yet. I don't read the headlines, because I know we're in a business day here as well. They have a newspaper, they come out of the Financial Mail. You've got to see it from business leaders, not from journalists, that things are starting to look better.
But over the last 3 years, David, if I've said to you, where's the smart money going, you're saying offshore.
Yes.
Would you have that same dogmatic view if you've got money, currency low, pound, euro, dollar, all much weaker?
Yeah.
If we see those markets moving up, even though we could get 4-5% appreciation in the rand, if you're going to get that as corresponding in terms of markets, rather be there. Would you now be holding back just a little bit and maybe dividing the portfolio between offshore and offshore?
No, I'm still offshore. And that's because I think there's so much excitement, which we haven't got here. We're still an old economy in terms of that. So,
David,
I'll qualify that.
You can qualify that when we come back, because while our clients now wait to hear what's all this excitement about, we've got to take a break. Stay tuned. We'll be back shortly.